Hello everyone, welcome to today's US Open. It is Thursday, February the 16th, 14:20 GMT, 10 minutes, before the US markets open. This is your host Nikos Zabouras, Senior Market Specialist at FXCM. We have quite a few things to talk about today. Again, less than an hour ago, we got the factory gate prices from the United States, which came in hotter than expected. Earlier in the day, we saw an uptick in Australian unemployment. Since our last session on Tuesday, we also got UK's CPI inflation report, which moderated, which showed another moderation for third month in a row. We also had some more oil-related news and a series of earnings reports from high-profile companies. However, before we get into it, as always, please read through the disclaimers carefully, and then we will begin. Once again, I urge you to read carefully the risk warnings and the disclaimers, and then we will get started. Okay, let's get the ball rolling since we have quite a few things to talk about as we look at the Euro USD chart. Before we get into that, let's get a quick catch up of what we saw since our last session. So earlier today, less than an hour ago, as we said, we got factory gate prices from the United States, and the producer price index, similar to what we had seen to the consumer price index a couple of days before. The figures came in hotter than expected, although slightly lower than the previous ones of the previous month, while jobless claims also fell. This puts pressure on Wall Street and helps the greenback, and we'll see that later on in our session. Now, earlier today, we also got Australian unemployment data, which showed a tick up in unemployment to 3.7%. This is the highest in 8 months, but still close to historical lows. Now, on Wednesday, we saw CPI inflation in the United Kingdom easing for the third month in a row, sending the pound lower and the stock market to record highs. We had more oil-related news as well around US inventories and the monthly report from the International Energy Agency. We will talk about further about all these things in a little bit. And before that, let's briefly go through some of the earnings reports we got over the last couple of days. UK's Barclays Bank reported a profit slump in 2022, and the stock plunged yesterday. Now, over in Australia, again yesterday, retail giant Wesfarmers, and it's actually a very diversified company. It also got chemicals and other business, but in any case, Wesfarmers over in Australia posted 20% revenue increase year over year and a 14% rise in net profit in the half year that ended December 31. Its stock jumped to the highest since March. Today we got results from aircraft manufacturer Airbus, European aircraft manufacturer Airbus. Markets reacted positively. So the company delivered 661 commercial airplanes last year, and its adjusted operating profit rose 16%. So these were quite good results, but it also offered upbeat guidance for the current year, seeing higher deliveries and higher profits. So that was just a quick recap of what we had around earnings. Now let's get into more details around Euro USD. We see here the 4-hourly chart as usual. So following the blockbuster jobs report that we have already talked about at the beginning of the month, this week's higher than expected CPI inflation we talked about on Tuesday, and another round of hawkish Fed commentary, markets now expect a higher terminal rate than previously, which is supportive of the US dollar. In fact, CME's Fed Watch tool at the time of writing assigns the highest probability to rates peaking at 5.5%. That's even higher than the Fed's implied projections, although it does still leave room for cuts towards the end of the year. Today's data that we mentioned, factory gate inflation, also supports this narrative, we would say, and the view that inflation is not it's likely gonna be more persistent, let's say, than markets had hoped. As a result, the pair comes from a 2-week losing streak and tests this critical resistance here. You can see that it has tested 1, 2, 3, and another fourth now time, which is 23.6% Fibonacci of the September low, February high recovery. Now, daily closes below it can open the door to the 38.2% level at around mid 104s, but we are a bit cautious for further downside that would breach the descending trend line from the September lows. This repricing, as we said, does support the greenback, but on the other hand, the monetary policy differential based on what the stated intentions of the two central banks is still in favor of the common currency, because the ECB has already delivered more hikes this year and will likely deliver more, again based on the stated intentions by policy makers. We're gonna have to see how this plays out. So we struggle to see extended weakness, and as we said, it has already defended this key support here, and as long as it stays above, this is just a limited correction, and the common currency can find the opportunity to push for new highs towards 1.1065, but again does not inspire much confidence given the current landscape for more at this stage. Now let's leave Euro USD behind us and let's move to GBP USD. As we see, let's go here to the 4-hour chart again. If you have any questions around what we discussed or any opinions and thoughts, we would be glad to hear them. You can type your thoughts on the chat box if you want us, if you want to share your thoughts with us. Now, on the GBP front, Wednesday data showed that headline CPI inflation is for third straight month to 10.1% in the United Kingdom, and core moderated to 5.8% year over year in January, both better than expected. This takes some of the pressure off from the Bank of England to keep tightening and send GBP USD lower, as you can see here. Now, it's hard to measure what the bank will do next, as communication is murky and there are divisions amongst policymakers, which were also evident in the recent parliamentary hearings. As things stand now, though, it's hard to see that interest rates have peaked. The bank has pointed potentially to more hikes, and it's hard to see the end just yet, although it's clear that the bank is close to its terminal rate. Now we can see that GBP USD trades below the 200 period EMA, the black line here, and this exposes it to 1.1840, 1.18, but we are still a bit cautious about a larger decline, and 114, the next big support, is obviously distant at this point. Now, on the other hand, the pair manages to not set lower lows. You can see it here, and this could help contain the drop. It's clear that it tries to react off of this level around 120. So we can't rule out new weekly highs, which is around this area, but moves past 1.25 seem quite tough at this stage. That's it for GBP USD. Let's now go ahead to AUD USD, because as we said, we had the employment figures there earlier. What we got is unemployment rate rising to 3.7%, and the highest in 8 months. Knee-jerk reaction, we can see that more clearly on the hourly chart. Knee-jerk reaction was lower, so this was it, but quickly covered the losses, but again now faces renewed pressure as the greenback attracts flows. Now on the technical front, you can see that there is a clear risk of a breach of this key confluence of support here. It includes the daily Ichimoku, the trend line from the October multi-year lows, and the 38% Fibonacci of the rebound after those lows. So this region can contain further pressures, but daily close below it would expose the pair to 0.6628. Now the Aussie does show some resilience, and the Reserve Bank of Australia is still on course for more tightening ahead, despite this higher inflation, higher unemployment rate. It still remains so close to 50-year low. So it's clear that the bank has more work to do, and that can be supportive. We can see a return above 0.7, but 0.7283 seems quite far away for now. Now let's shift gears and talk about US oil. The truth is that the technical outlook has not changed much over the recent period and from what we talked about on Tuesday, but we got some fresh news around oil. US stockpiles expanded by 16.3 million barrels last week, a big build-up. These were data from yesterday, but optimism around China is supportive. The International Energy Agency released its latest monthly report, upgrading again the demand outlook for 2023. It now expects global oil demand to rise by 2 million barrels per day from 0.9 million barrels percent in the previous projections, and this is fueled by a resurgent China. Resurgent is quote unquote, and that will account for nearly half of that increase. So this is supportive for prices. Now, of course, markets have to contemplate a potentially tougher Fed and recent China US tensions and this flying object saga. As such, there is scope for renewed pressure towards this key region that we have identified again at around 1723.70, but sustained weakness below it is tough given China's return. Now it tries to stay above the 200 period EMA, and it has the ability to push higher towards 84.70, but does not inspire confidence for taking this level out. And as we are already 5 minutes into the US session, let's round things off with NAS 100, the tech heavy index. You can see that it is losing ground today after the data we got from the United States earlier. Now, the index is cautious after the market repricing around the Fed that we already discussed and have been discussing this month. It has lost its vigor, let's say. This creates risk for a test of this region here around 12K, which has the 200 period EMA and the 38% Fibonacci of its latest recovery. But it would need a strong catalyst for daily close below that would open the door towards the daily Ichimoku cloud. Now, despite these headwinds, bulls are still clearly in control. And in fact, the index has broken into bull territory, gaining around 20% from its recent lows. And we can see a renewed effort higher towards 13,200, but we are cautious for further advance and a challenge of 13,724. So that's it in regards to the technical outlook. As well as always, we will talk about what's coming next. Not much, the truth is, this week, mostly UK retail sales on Friday. Now moving into next weekend before our Tuesday session, we'll be getting preliminary PMIs from a series of regions and countries, but things really heat up towards the second half of the week, and we will have the chance to elaborate on those releases on Tuesday. That's it for me. Thank you for joining.